Next up, we have John Filipetti. John is the Vice President of Design and Innovation at Oxford Properties. With a background in architecture from the University of Waterloo and over 20 years of experience in real estate development, John leads development projects with a strong retail and mixed-use focus. As a development executive, he leads internal and external teams in the completion of financial analysis, municipal approvals, co-owner liaisons, and project design, as well as coordination with Oxford's legal, leasing, construction teams. Please welcome John.
There we go. Thank you, Wayne. Can everybody hear me okay?
Yep.
Yeah, great. Okay, thanks. Well, great to be talking to everyone today. So I just have a few slides that I will share that give a little bit of a perspective on the economic side of development. And so let me see if I can get this sharing going here. Okay, fantastic. So what I'm going to cover today is a little bit about in our world, which is essentially a pension fund institutional development world, why buildings get built in the first place, what drives their construction, and then a little bit about how things get built. What are the some of the mechanics behind the buildings actually getting built, and then I guess these days no presentation's complete without some commentary on, what's coming at us in the future. But I'm afraid I don't have any more insights than anyone else might have. But it'll be an interesting starter, anyways. So for us, commercial real estate is specific in the sense that it's intended to produce an income, and it covers many different sectors: industrial, commercial, residential, as Peter was just speaking about, both condominiums for sale and rental properties that are retained by the developer and become income producing, retail properties, industrial, hotels, etc., and specialty real estate as well, such as data centers. The real estate is unique in the sense that it really relies on two markets, which I'll get into in a moment, to function properly. And markets are, I think, something we take for granted in the Western world, but markets are an important part of how all the economies function and how signals get sent from the demand side of people that need certain things, or businesses that need certain things, and other parts of the economy that supply those things. And they're fantastic in the sense that they, there's always some bumps in the road, but they do provide a sort of voluntary and mutually beneficial way of people exchanging, satisfying a need with a product that they can produce. And markets function through a bunch of pricing signals, and you could see in Peter's presentation how all those signals of supply and demand can get skewed by public policy as well. But they, at the end of the day, the markets are still trying to respond within the context that we create for them, still trying to respond to supply and demand. So why am I talking about markets when we're at a School of Architecture, not a School of Economics? Because commercial real estate is really driven by the confluence of two markets: the market for space, people that need a place to do business or a place to live, and the investment market. In commercial real estate, there's a huge demand for investors that want to place money in real estate because it's seen as a stable, consistent, secure asset that can help them diversify away from the more typical investment assets like the stock market and the bond market and things like that, which are much more volatile. So, just to just touch on those points a little bit further, it's that overlapping of the market for space with the investment market, and the pictures of downtown Toronto that Peter showed were fascinating, because that is a great example of where you have a confluence of the desire for those businesses at the time, which was heavily oriented towards the financial sector, those businesses needing space and wanting to be in that location because it was, had good transit and was convenient to all their workforce, which lived in the surrounding areas. And also the desire for those corporations to invest in real estate as one of multiple investment classes that they invest in. In the case of a pension fund, like the owner of Oxford, and I'll go into that in a bit more detail in a few moments. Real estate has another aspect to it, which is important, which is called liability matching, which is in the sense that real estate assets tend to be long-lived. If everyone does their jobs properly, it can be very long-lived, and they can match up very well with long-term liabilities like a pension fund has. So, I mean, that's one of the most kind of lie awake at night issues that pension fund managers have now is, life expectancies are getting longer and longer, which is wonderful news for everyone. Although it does raise questions about how to make the funds viable over the long term. So it just puts more and more emphasis on having a strong investment strategy that matches up with the long-term liabilities. So we were at a recent conference, and one of the senior executives of the pension fund pointed out that they're now planning for 100-year liabilities, because a young worker that, say, gets employed in some part of a city, maybe they came straight out of high school, they started working in the works department or parks department, they could be as young as 18, 19 years old. Their life expectancy is pushing into 3 digits. And if they marry someone a few years younger than them, their survivor benefit could reach into like 10 decades, 100 years. So it's quite remarkable in terms of talk about long-term thinking, to have to think about your investment horizon as 100 years. That's a pretty substantial, mind-bending sort of thing to think about. So real estate works well from that point of view, because they tend to be assets that hang around for a long time and are productive for a long period of time. So, so just to recap, real estate does satisfy both the needs of the occupiers, so businesses, and people needing a place to live, with investors looking for a place to invest. So I'm going to touch on a few fundamentals around the business of development. So there's a number of different types of developers. There's merchant developers who have built most of the, the condos that Peter was referring to. So they, they buy the land, they develop the property, they sell the units, and then they repeat, and that's their business over and over again. And that's a huge part of the development sector. There's a smaller sector, which we'll call just the occupiers, that develop for themselves because they either just want to control their real estate, or they have such specific needs that they need to develop it themselves. So an example of that would be IKEA, where they have these huge stores, they have very specific requirements, and we haven't seen it so much in Canada, but in Europe, certainly they start to develop whole shopping districts around their stores. And, so they recognize their value as a kind of a attractor of customers, and they try to leverage that to become a landlord for a larger area. And then something like Prologix, who are an industrial warehousing logistics firm, they have very specific requirements, so they develop for themselves as well. And then finally have the institutional developers such as Oxford Properties and Cadillac Fairview and other development companies that are owned by or financed by pension funds and insurance companies. They're looking to create a long-term value, and because they are looking to produce that cash flow over a long period of time. So, and why do we develop and not just buy the properties? And the fundamental reason is because we can get better assets by building them ourselves than we can by buying them. So for instance, you know, in downtown Toronto, the last, you know, those office towers are considered trophy assets. You know, they trade maybe once every 5 years. One of them might come to the market for some reason. I think the last one that came to the market was Scotia Plaza, and it was, you know, sought after by many investors. So if you want to own assets like that, you really have to create them yourselves. And so that's what a lot of the institutional developers will do, is you'll find a site that's maybe not zoned properly, or it's suboptimal in some way, and you'll put in the effort required to rezone it and build your own Class A asset, and then, you know, continue, and then you can hold that in. By going through that effort, you can build it in a place that has a high barrier to entry, so you won't have competition. You won't have as much competition, and you'll be able to, you know, your asset will do better over time. Just check on my time here. So, so just to touch a little bit on, you know, the public pension fund investors. So in our case, Oxford is 100% owned by OMERS, which stands for Ontario Municipal Retirement Employees Retirement System. So the fund is worth north of $100 billion. So it's, I think in Canada, we would be the third or fourth largest pension fund. Canada is unique in the pension world in that it has very robust and active, strong pension fund management, whereas in the US, you often find pension funds are, they take a much more passive role, and they tend to just buy investments through other commercial investment managers rather than building up their own hierarchy of and their own investment organizations. So it's a very different world. But in Canada, we do have these hierarchies, or these organizations that have been built specifically for the purposes of creating investments that are perfectly suited to the needs of a pension fund. So, you know, what our OMERS mandate is to think about, you know, the long-term needs of our pensioners. We've got, I think, about 500,000 active and retired plan members, and so that's a lot of people that are depending on us for their sort of security in their retirement. And as I mentioned earlier, a very long horizon of thinking around that. The neat thing about the pension fund world is there's a kind of a broader social value that comes with it as well, that you know, we're providing pension security to as I mentioned, about 500,000 people. They pay taxes on, the fund operates on a tax-free basis, but once we disperse the money to the plan members, they pay taxes on that income, and that, you know, that helps the economy flow as well. And then we also invest in many companies in Canada as well as abroad, and, you know, that helps to, and we tend to take a long-term view, so we think that that's a good thing for economies to have those long-term investors working on things. So when we look at investments, we try to break them down into different risk categories. And so we've got the simple graphic here, and I'm going to apologize now. I'm kind of, I think Larry Smith comes from the world of economics, and I'm in a way glad he's not here, because I'm probably going to commit a number of misdemeanors in explaining some economic principles. But you'll just have to take everything I say with a grain of salt. But basically, we look at our investment opportunities along the two dimensions of risk and return. So return being, how much profit can you make from it? So generally, the way the economy prices risk is that, things that are riskier provide a higher return, and that's how the sort of supply and demand curve gets filled in. That as something gets more risky, investors look for a little higher return to compensate them for taking that risk, because it doesn't things. I guess you could argue in the past 10 or 15 years, it's been pretty buoyant economy in the development world, and there haven't been that many misfires, but certainly, recent events have shown us that things don't always continue to trend upwards, and so risk is a real thing. So there's three categories. There's core, which you could equate to like a blue chip stock, if you know anything about stock market investing. So very stable, very consistent performance, very, not necessarily highest returns, but just very steady. Then you have in the middle, you have the value added type of investments where there's a little more risk, and because of that, you get a little higher return. So this might be in a location that's close to a very good location, but maybe is a bit off and has some strong characteristics, but maybe has some issues that need to be dealt with. And then finally, you have the opportunistic you have the opportunistic type investments where, there's a higher, you're at the outer end of the risk spectrum. So, a number of challenges associated with these, but the upside is that if things go well, you can be well rewarded because you tend to get paid a higher return when you take the higher risks. So the equivalent of that would be a startup, investing in a startup company where, a number of them are going to fail, but some will succeed, and some of those successes will be big successes. So in the pension fund world, we tend to work in these, the core and the value add world, just because as a long-term investor, we find that we can get sufficient returns in the value add space, and as well the core holdings can provide that steady return that we need over time. So there's a couple tools that we use very critically to address our, to analyze projects and understand how they're going to operate. And so the critical one is called the pro forma. So every project that Peter showed you, it would have started with a very simple diagram even before the architect got engaged, and a very simple pro forma to see if the project pencils out. So the simple, and these will grow into, Excel spreadsheets that have dozens and dozens of pages to them, but initially it starts with just these kind of 7 lines, your project costs, your revenues, your net cash flow, the impact of financing, and then the net cash flow to the developer compared to how much cash they have to put into the deal to make it work, and does that provide them with a return that's a reasonable return for the risk that they're taking on. So some version of this will be done for virtually every commercial project that you see getting built in the world. So that's one tool, and then I'm just going to quickly touch on 5 more tools, and we're not going to go through these in great detail, but there may be things that you hear about if you ever work with a developer client, you're going to hear about these issues. And so you can, if you're interested in them, Google is a wonderful resource. There's tons of stuff on there about how they work and what they mean, and in many cases, it's been boiled down to very understandable descriptions. So the key things are these 5. So the cap rate, which talks about valuing a project, and it's basically a valuation metric that incorporates an idea about risk. So, the riskier projects have a higher cap rate, and the less risky projects have a lower cap rate, which equates to a lower return. That's really, in the essence, that's what it is. Discounted cash flow, that's a method of valuing cash flows over time. So it takes into account what might happen in year 5, in year 6, in year 10. and then brings it all back to kind of a current value. So you can compare different projects on a similar basis. The third one is financial leverage. So that's a critical piece because all those projects, including the condos, as Peter mentioned, rely on leverage to get built. And that's one of the magical parts of our financial system is through, and I'm going to touch on this. I've got one more slide that touches on it, does a bit more detail, but through leverage, you can parcel out the risk to different types of investors who are comfortable with that level of risk. I'll get to that in a minute. But basically it results in, similar to the way concrete construction has become an extremely efficient way of building buildings in Toronto, leverage has become a very efficient way of financing them. Net effective rent for commercial projects, such as office buildings, it's a way of valuing the impact of a flow of rent that might have payments going both ways in it throughout the life of that lease. And finally, residual land value, which is basically a way that developers figure out how much can I pay for that piece of land, or how much can I pay for that building that I need to renovate. And so you basically determine how much the finished product's going to be worth, how much it's going to cost to get there, to build it, and whatever's left to the residual, that's how much you can pay for the land. So that's why it's called land residual. So just want to touch a little bit on the leverage piece. It's got a neat name. They call it the capital stack because it just equates, it breaks down the different types of financing within the project. And it's a neat way of efficiently distributing the risk to different investors who are looking for different things. So you can have the common equity, that's the actual owner of the property, that their cash is upfront, and if there's any loss, they're the one that take the loss first. Then you have the preferred equity and the mezzanine debt. So those are the lenders that are they're lending on top of the regular mortgage. So if there are further losses, they are at risk first. And then finally, you have what's called the senior debt. That's like if you were buying a house, that would be like your traditional mortgage. And they have the most, that's the most stable position, and they are they're risk averse. So they're looking that it's your debt that's going to be at the lowest rate, but also it has the least risk attached to it as well. So the stack is interesting because you could sort of say, well, that's equivalent to value. They might only lend you a little over half of the value of your property. So the value would have to go down at least by half before they would be at risk of losing anything. So it's just, it's just part of a very efficient system for financing commercial real estate projects. So I'm going to touch briefly now on how we develop our projects, and just go into the sort of the development process. And I'm not going to go into it in great detail, but it's an iterative process, and it's got a ton of different pieces to it. This implies it's got a very linear track to it. In reality, there's some loops that happen. So you start out by determining the highest and best use for a piece of land or a building. You move into concept design. That's typically when the architects get involved. You start doing a financial feasibility, and you may loop back a few times or more than a few times to arrive at the right concept. So that's why we call it iterative. And then you move forward into the planning process. And as Peter mentioned, particularly in Toronto, it's a very Byzantine, complicated process. It's a very every approval seems to be different from the ones you've done in the past, which in a way is great for architects and all the people that work in the development world, in a sense, because it requires a lot of effort. So it just creates, it's in a sense, it's creating a lot of employment for planners and municipal lawyers. But certainly doesn't add to the efficiency of our whole system, because it is a lot of the work that gets done is reworking things that might have been arrived at more quickly. And then you move into financing, which, you know, it's interesting in the pension fund world. Our financing is you know, it's pretty as simple as sending an email to the, you know, to our finance department, because we self-finance much of what we build. But if you're a private sector, if you're, you know, a private sector developer, you have to go out into the lending world and find people that are interested in financing your project. So they become clients as much as your end user in a sense, because you have to make sure they're happy and that they like what you're building. And then finally, you get into the construction process. And then this is kind of a breakdown of the first couple of parts of the process, which is very it's a very intense and very creative part of the whole process, and in my mind, one of the most exciting, because it's when you're physically establishing the concept for the building, as well as putting together the sort of financial concept of it as well. So that's where all the pieces come together. So you start with the physical site assessment, you do your zoning analysis, which, you know, can be quite complex, especially when, as Peter said, you know, the zoning bylaws that are in the book are so out of date that everything is a negotiation. You get into a market analysis for the particular type of project that you're intending to build. Then you get into your conceptual design and schematics. So this is where, the real creativity is happening at that phase. Construction cost estimates, and you may have to, you know, again, do some iterations here to bring your costs in line with what your financial model says you can afford and still make a good return. And then finally, you arrive at a final development concept. So, you know, it's an exciting part of a process, and there's a lot of creativity that goes in on all sides, both, you know, the design creativity as well as, you know, the planners figuring out, you know, the right approach and the right strategy to get the project approved. The construction strategy is as well, or it can be very important, you know, as well as, you know, the financial engineering that goes into it. So I'm just going to end off by a very brief, you know, some very brief comments about what's happening now. Because I know some of you, you know, are at the end of your schooling or close to the end, or it's looming in a few years. And what kind of world are you going to enter into? And, you know, no one knows at all where things exactly are headed. I mean, we're in a great position in Canada and Toronto specifically, because we were coming from a position of relative strength. You know, we had good infrastructure, you know, a good financial basis, relatively stable governments, and the economy was reasonably healthy. So those are all positive characteristics. You know, if you're going to have a crisis, it's not a bad place to start from. You know, what we see is you know, COVID has really just accelerated a whole bunch of trends that were already underway and already start moving, albeit at a slower rate, and they've just accelerated to hyperspeed. So for instance, working from home, as we all are now, it was something that in the real estate world and the office world, people talked about. We've been talking about it for 10 or 15 years, and you know, trying little experiments here and there. Oh, I'm going to work from home 2 days this month, you know, big advancement. And all of a sudden, well, we've all been working at home for 4 months. So it's, you know, those sorts of accelerations are going to take time to digest, but it's certainly something to give significant thought to. You know, I guess I'll just end off with that quote that's misassigned to Ben Franklin often, which is, you know, if you have a lot of time to cut down a tree, you should spend most of it sharpening the axe. So maybe this is a time to, you know, if employment is not immediately available, it's time to, you know, spend some time sharpening your axe. Because one thing I'm pretty sure about in Toronto and in Canada is that, you know, things are going to come back, and they're probably going to come back pretty quickly. But it might, you know, it may take 2 years or so, but it's definitely, things are going to rebuild, and there will be a rebirth. It will just take some time. So it's a question of what do you do during that time. So I think I'll end there, and thank you all very much for your attention, and look forward to the further discussion.